The stock market can seem like a complicated place, but it's simpler than you think. Imagine a giant shop where pieces of companies are bought and sold. These pieces are called stocks or shares. When you buy a share, you own a tiny part of that company. Think of it like buying a piece of your favorite bakery. As the bakery sells more cakes and earns more money, your piece of the bakery becomes more valuable. The stock market is like a bustling marketplace where these pieces of companies are traded. Just like in a real marketplace, prices go up and down based on supply and demand. If more people want to buy a stock, its price goes up. If more people want to sell, the price goes down. In simple terms, the stock market is where you can buy and sell pieces of companies, hoping that your investment will grow in value over time. Let's break down how the stock market works. Companies list their shares on stock exchanges like the Bombay Stock Exchange or the National Stock Exchange in India. These exchanges act as platforms for buying and selling stocks. You don't go to the exchange directly to buy stocks. Instead, you open a demat account with a stockbroker like Zerodha or Upstocks. Think of a demat account as your digital locker for storing your shares. When you want to buy a share, your broker places an order on your behalf on the stock exchange. If a seller is willing to sell at that price, the trade happens electronically, and the shares are transferred to your demat account. The stock market operates through a network of buyers and sellers, facilitated by brokers and exchanges. It's a dynamic system where prices fluctuate based on various factors, including company performance, economic conditions, and investor sentiment. Investing in the stock market offers the potential for long-term growth. When you buy shares of a company that performs well, its stock price tends to increase, allowing your investment to grow. Over time, the stock market has historically trended upwards, even with short-term fluctuations. This means that by investing wisely and holding your investments for the long haul, you have the opportunity to build wealth and achieve your financial goals. Moreover, investing in the stock market helps you beat inflation. Inflation erodes the purchasing power of your money over time, but stock market returns have the potential to outpace inflation, preserving and growing your wealth. Investing in the stock market also provides diversification. By spreading your investments across different companies and sectors, you reduce the risk of putting all your eggs in one basket. Section 4. Understanding the risks of the stock market. While the stock market offers potential rewards, it's essential to understand the risks involved. The stock market is inherently volatile, meaning that prices can go up and down significantly in the short term. External factors such as economic recessions or geopolitical events can impact the entire market, causing widespread price swings. It's crucial to be prepared for these fluctuations and avoid making impulsive investment decisions based on fear or panic. Another risk is company-specific risk. Even if the overall market is performing well, individual companies can face challenges that affect their stock price. For instance, poor management decisions or increased competition can negatively impact a company's performance and, consequently, its stock price. It's vital to conduct thorough research, diversify your portfolio, and invest for the long term to mitigate these risks. Section 5. Getting started. Your first steps in the stock market. Starting your stock market journey is easier than you might think. The first step is to open a demat account with a reputable stockbroker. Choose a broker that offers a user-friendly platform, low fees, and good customer support. Once your demat account is set up, you can start investing. It's crucial to start small and gradually increase your investment amount as you gain more experience and confidence. Before investing in any stock, do your research. Understand the company's business model, its financials, its management team, and its growth prospects. You can find this information on the company's website, financial news websites, and stock analysis platforms. Consider starting with index funds or exchange-traded funds, also known as ETFs. These funds pool money from multiple investors to invest in a diversified basket of stocks, providing instant diversification. Section 6. Common mistakes to avoid as a new investor. As a beginner, it's natural to make mistakes, but it's important to learn from them. One common mistake is investing based on emotions, such as fear or greed. Avoid making impulsive decisions based on short-term market fluctuations. Instead, stick to your investment plan and focus on the long term. Another mistake is putting all your eggs in one basket. Diversify your portfolio by investing in different companies, sectors, and asset classes to reduce your overall risk. Timing the market is also a common mistake. Trying to predict when the market will go up or down is extremely difficult, even for experienced investors. Instead of trying to time the market, focus on investing consistently over time. Finally, don't be afraid to seek help from a financial advisor if you need guidance. A qualified advisor can provide personalized advice based on your financial goals, risk tolerance, and investment horizon. Section 7. Conclusion. Embark on your stock market journey. The stock market, while seemingly complex, presents an exciting opportunity for individuals to grow their wealth and achieve their financial aspirations. By understanding the fundamental principles, embracing a long-term perspective, and avoiding common pitfalls, you can navigate the stock market with confidence. Remember, investing is a marathon, not a sprint. Start small, learn continuously, and stay invested for the long haul. The stock market, with its inherent risks and rewards, can be your gateway to financial freedom.